March is Women's History Month, and I've invited iCapital Managing Director of Private Wealth Solutions, Corinne Salmon, to help us answer your question of the month. This one comes from John, who's asking, with markets at all-time highs, are we seeing other advisors adding more protection? So Corinne, thanks so much for being here. And you're a perfect person to talk to about that because you spend your day talking to financial advisors and talking to them about what type of structured investment solutions that are out there. And so what's your take? Are we seeing more advisors asking for protection for their portfolios?
Yeah, and I think that's a great question, Anastasia. And what I would say is there's a couple of different ways to answer that. But my first answer would be yes, we are, particularly in two structured investments. One would be a short-dated buffered note, right? So 15 months, 18 months, 21 months, typically with something like the S&P as the underlying. Right, and as you know, that's usually something that advisors use as an alternative to a direct investment. So you'd like to be invested in the market, but you also want some protection on the downside. Typically, I'd say, Anastasia, we see about a 10% hard buffer there.
Yeah.
Now we're definitely getting more inquiries for 15, even 20% hard buffers.
Right, and that of course makes sense for a couple of reasons. You know, first of all, on average, as a lot of advisors know, you get something like on average a 5% pullback every quarter and on average a 10% pullback once a year. But this hasn't been an average year. This hasn't been an average, let's say 15 months. And so the S&P rallied, or the NASDAQ, rallied so sharply since October. So I think that's what's driving that interest for some additional protection.
Definitely, I would agree with that. And so if you're going from a 10 hard buffer to a 15 hard buffer, you just have to remember you're willing to give up some on the upside, right? You're willing to give up some potential profits on the upside so that you have more protection on the downside.
Right. And what's the other structure that folks are interested in?
Yeah, the other structure I would say are short to medium term income notes. Okay. So typically what we see there, Anastasia, is a 70-70, right? And simply what that means is you have 30% contingent protection on your coupon and you have 30% contingent protection on your principal. We are seeing advisors add about 10% to the contingent protection on the principal. And what that does is it brings the coupon in about 60 to 75 basis points, right? So if you're getting it 9 3/4 on a 70-70, you're probably looking at about 9 to 9.15 on a 60-70.
Right. So that really to me speaks to the appetite to kind of beef up the protection a little bit, right? Sure. So you're willing to give up a little bit of the coupon. You may be willing to, set the cap a little bit lower to give yourself a little bit more wiggle room on the downside.
Yeah.
And so, but we're talking about buffers and we're talking about 10, 15% protection. But I guess my question to you is, what level of protection do you think is needed right now?
Yeah, so that's obviously personal opinion. For me, I'd probably feel pretty comfortable with about a 15 hard buffer, I'd say. Do I think we'll have a big pullback? Probably not, but we are, at all-time highs here. So, and I would say, Anastasia, the wonderful thing about structured investments is no matter what your view, there is a structured investment out there for you. So if you think that the market will continue to rip to the upside, let's show you something that has robust upside participation and is uncapped. Right? Maybe you think that the market will be muted to range bound over the next 12 to 18 months. Okay, well then why don't we show you something that has a good chance of making money if the market's up, if it's down, or if it's flat.
Right. And, some of it has to do with where the market ultimately goes, but the other part has to do with what exposures do you have, right? So for example, you could have a client who has been sitting in cash and sort of missed this tremendous rally that we have, in which case you may want to try to play catch up and you may want to incorporate something that gives you that, 2 or 3 times leverage on the upside. But then you may have another client who's done very well in the tech trade.
Yeah.
And now there is a real risk for a 10, 15% correction. So, for that, you might want to replace some of that Delta One, all in, all equity exposure with something buffered on the downside as well.
Yeah.
So, Corinne, thank you so much for helping us answer the question and a few more that were underlying that.
Yes. So, thank you so much for having me.
Thanks for joining. Well, thank you, Corinne, and thank you, John, for your excellent question. I'm Anastasia Amoroso, and thank you for joining us today. We'll see you next time on Beyond 60/40.